Apple stock is overvalued by 23 to 44% based on this trailing 12 months fair value ranges. This fair value range is derived from the multiple 22 to 26 times multiple, which is the right price, I believe, for their margins, the stock. Here is Apple stock historical margins in the past 15 years. My valuation process is based on the premise that I pay one times multiple, for 1% of their margins. Meaning, for Apple, based on this data of 15 years, fair value should be 22 to 26 times multiples because their margins, as you can see here, averages from 22 to 26%. That's why I think 22 to 26 times multiple is a very much supported multiple for Apple stock. This multiple should hold and will only be true if they continuously print 22 to 26% margin. Now, granted, they can print 28% margins, even as high as 30, 31, even 35% for some quarters. But in the grand scheme of things, if you look at it from a yearly basis, 12 months basis, it evens out to this 22 to 26% margins. Another way to validate this multiple is looking at the OI range, this this here, operating income margin. From here you can see that OI can be as low as 28 to 30%, even 31. But OI, remember, still includes business tax. And tax is still a cost of doing business. I believe they call this EBITDA. I don't really use that. So really, Apple stock should not have or shouldn't trade above 30 times multiple because then we'd be paying a lot for a stock that's not, you know, really growing a lot. Anyway, that's how it should be in the real efficient markets. There's another way I look at things here. I call it EMT, efficient market theory. It doesn't really take into account the prints, the one offs, the best ones, the terrible ones. But it maps where the stock is trading just based on the revenues you put. In this case, I use during 12 months and the shares outstanding, which you can see from the Edgar. Right now, it's trading. Right now, it's trading at 30 times, meaning Apple at around 237 is trading like it's printing 30% margins. But are they? Based on prints, they're not. So this anomaly should be a function of growth or just pure speculation. Also remember 30% OI is like the top range, right? That means Apple here is trading fully even with taxes as part of its valuation. Now, of course, if you get to buy it at 22 times, that means you can expect a higher rate of return on your investment. That is why I've been all over big tech stocks back in 2022. You can see that. At the time, I thought they were relatively cheap. Not exactly cheap, but they're trading around fair values. If we look at Apple stock now, it's defied gravity. I remember writing on Patreon, now deleted, that Apple stock is dead money because look at these fair value ranges. It's not moving. But what really happened is the very questionable increase. in future estimates, hence the surge in price. These fair value ranges are 22 to 26 times multiples based on future estimates from analysts. Is it really possible that Apple grow 6.01% next year and 8.08% after that year? How about this? Can Apple grow 15%, roughly 15%, in the next 2 years? When was the last time they pulled that? I'm not saying no, but even I think it's a little weird, wild, unrealistic. Um, See, this is why I only pay that for the 3 and 12 months fair value ranges. I don't bet on the future. I rarely bet on growth because it's speculative. Uh, with the stock this high already, the return most likely is zero to negative. This is why Warren Buffett is selling. His money is better put in bonds and treasuries. Apple here is an easy sell. I'm gonna stick with dead money, but 200 is such a level break. You might want to dip buy there, technically, but I don't like it even at 200. But you do you. I think the risks outweigh the rewards here. But hey, maybe they can grow 15% in the next 2 years.